Well, is this it? Is this finally the start of the quote bubble popping? I mean, technically, the charts look fine, and Friday really wasn't that damaging, but behind the curtains, the intermarket relationships, we've got some cracks showing up that I need to show you. So let's take a look through the data points and build a logical game plan for the week ahead. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe. Remember, we're trying to hit 100K by May. Let's see if we can do it. And stick around until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure, we've got ourselves an indecisive doji with about equal parts upper and lower wick and a body that's relatively unchanged from the candle open. There's a small edge to the bears because we did technically speaking close red, but I wouldn't read into it too much. I would say that we're neutral in terms of candle structure. If we think about location then, on the bar-to-bar count, we've got ourselves an equal low and yet a higher high, but we did close inside of the previous week's range. So again, I'm drawn more so towards the neutral outlook here because we did produce that higher high, and maybe that counterbalances the red close on the structure, but we've closed back inside of and basically unchanged from the previous week's close. So neutral across the board when we think about structure and location here on the weekly. One thing you could read into is just understanding that that higher high was an attempt to make a new all-time high, and we did not close up there. So is it a subtle sign of rejection or uncertainty at that all-time high? To me, the answer might be yes, but it's not enough to change our tone on the weekly time frame, because if we think about the trend, it's certainly still up, and if anything, we would be pulling back from a new higher high in the trend count, and therefore we know we can afford a higher low. And the top of mind levels that we'll continue to talk about are really the top of the 2-week balance right here, the bottom of the 2-week balance, as well as the top of this area back here, as not only a weekly balance area, but if we just auto zoom this chart, we remember its confluence with the previous all-time high as well. This is really the more important line in the sand on the weekly time frame, and to give you the number, it's 480 down to 477 as a 3-point zone. The reason it becomes more important is because if we come in from the October low with a Fibonacci to the new all-time high, notice that the 38.2 is now perfect confluence with that level. So if we were to get a pullback, this would technically be classified as healthy either bull flag consolidation. The depth of the pullback is not concerning as long as we're over 480 from a trend point of view, Fibonacci point of view, right? So how could we get there? Well, the first step on the weekly time frame chart, and I'm not forecasting this as a likely outcome because we just described how the weekly chart is really more neutral with the indecisive doji, right? But if we were to break down underneath the 2 now equal weekly lows, we could move into the 2-week balance range here. And then underneath 490, which is the bottom of that balance range, opens the door for about 10 points into 480, 477, that 3-point zone we were just discussing, right? So that to me is fairly interesting. If we bring out the anchored VWAPs on the weekly time frame chart, this sort of supports the thesis coming in with this anchored VWAP that if we were to break down underneath that 490 zone, then 480 could be achievable, right? This is a very likely outcome. Breaking this anchored VWAP, not unreasonable for the deeper pullback. But once again, just want to rewind our focus to being back up here and saying we're still neutral. We're just talking about possible downside outcomes that could get us to 480, but we haven't even made a new weekly lower low yet. So let's not jump the gun. If we were to continue in the upward direction, of course, we're still looking at blue sky territories. Let's finish it up with the volume profile on the weekly time frame chart, just reminding ourselves that this is a high volume node. If we extrapolate this one, it's loosely aligned with the bottom of the 2-week balance here. So again, underneath 490 makes sense to go to 480, but we're not there yet. And if we come in with the Fibonacci extensions, it is cool to, I'm sort of happy, I should say, to report that we've hit the target of the cup and handle, right? If we come back down to the base of the handle, we've hit 520 for all intents and purposes. We're a little bit shy, but we did complete the measured move. So if we were to pull back here, is it at a reasonable location? To me, the answer is yes, but you probably want to wait for a breakdown of the 2 equal lows to bring in a weekly lower low. And then just as a general reminder, if we take a look at this 61.8, it's also confluence with the top of the balance range, 477, 480. So I don't think we want to change our tone to being overly aggressive bears. Is it reasonable a pullback could unfold? The answer is yes. Do we want to jump the gun on that? Probably not. If you're looking for an Armageddon style sell-off, we'll just continue to reinforce the idea that the weekly trend should be down before many of the major instances of large aggressive sell-offs. So positional traders, swing style traders, this is probably not enough to completely reconsider your positions. You might want to button some things up, but we're not flipping bearish on the weekly time frame. Remember, your time frame of execution must match your time frame of analysis. With that said, let's move down to the daily. So let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 520.28, implying a very nuanced higher high. And if we're contained by the lower bound, the number's 503.10, implying just as nuanced of a lower low. So it's not clear that the expected move is bullish or bearish. I would really call it more neutral, just like the weekly time frame chart. If we think about the current trend sequence, it's certainly up. We've got ourselves lows, higher lows, higher lows. Higher lows in here. This was an equal low on the Tuesday session. And along the way, highs, higher highs, and we're pulling back from a new all-time high that was produced on the Friday session. So we know that just like the weekly time frame chart, we can continue to afford a higher low pullback without jeopardizing the daily trend. So what is the top of mind level? Well, first and foremost, let's acknowledge that the Friday structure is a bearish engulfer, right? We looked over Thursday's high, did not get any price acceptance up there, and then closed underneath Thursday's low. So it would make more sense to me that the momentum could possibly continue in the downward direction, right? So the probabilities would sort of favor this. And if we could find a daily higher low over 509, that just easily continues the daily uptrend, offering a higher low and possible continuation in the upward direction. Although less probable, if we were to get consolidation up here, that already speaks for itself. We have lows, higher lows, and a breakout of some balance that may form would just bring in a higher high and continue the daily uptrend. So staying over 512 for daily consolidation bullish, or higher low pullbacks over 509, also more bullish than bearish. If we were to move underneath 509, I would really change my tone to more neutral through here. Let me explain why. If we think about the structure outside of just the Friday bearish engulfer, on Monday, and we skipped the Wednesday video, so let's do a little bit of a recap, right? We looked over Friday's high of last week and then closed inside of Friday's range. Bearish inverted hammer, right? Rejecting that all-time high. We gap down on Tuesday and create an equal low. Not the end of the world because we're coming from the highest high. But if the bears were going to maintain some sort of edge here, as we talked about in last week's episode, we really talked about how they would want to see some sort of lower high, setting up a daily head and shoulders for the reversal. Now, did that take place on the Wednesday follow-up session is the key question, and the answer is obviously no. We opened at the highs, almost dead on the highs of the Tuesday range, right? We closed the gap above and then reject back down for a close inside of Tuesday's range. So at that point, there's still somewhat of an edge to the bears because we had a gap fill reversal of this little area right here, and we've still closed weak away from this all-time high. So, okay, still possible that the bears could produce something that looks like this. Now, of course, what's the kicker? Thursday opens on a gap up. And now we have a beautiful intraday gap fill reversal back to the upside, making a new all-time high. I do not think it's fair to say that we have stronger sellers in this market still. Again, we will completely concede that Friday is a bearish engulfer. It would make more sense to me that momentum could possibly continue into 509, and I would be thinking very carefully about whether or not buyers step up on the retest of 509. If we were to get something that looks like this, that is rainbows and butterflies, put it in a textbook, the buyers remain in control. If we were to flip underneath 509, get consolidation here, a little bit more neutral, and I'm sure you can clearly tell where we flip bearish underneath 505.25, the NVIDIA earnings gap up is totally in play. So don't get me wrong, are we willing to change our tone when the price action warrants it? Absolutely. Are we there yet? The answer is seemingly no, based on all of the interactions we've just walked through in this section of the chart. We failed to produce a daily lower high. We had a gap fill reversal on Thursday. We're coming from the highest high in the trend cycle. I don't really think that there's a reason to jump the gun on the bear side. We'll change our tone again when we have to, and that would likely be underneath 505.25. Could we achieve that this week? Absolutely. Look at the lower edge of this week's expected move. The market's pricing in more volatility than last week. We do get the updated CPI print coming out, and that, of course, could be a factor in the analysis here. But one of the things we'll explore in the core list of companies is that NVIDIA implied volatility has moved through the roof. And obviously, we all know what took place, down 8% on Friday. So if the one stock to rule them all is going to start to break down, of course, this could be in play. I just don't think we want to be the hero jumping the gun and stepping in front of a moving freight train. The last thing to look at here on the daily time frame chart is our trend channel. Remember, we made the argument that the market is moving in a linear fashion. If we find support off of the bottom end of the channel and continue to move in the upward direction, that of course would continue to support more of a bullish thesis on the daily time frame. On the hourly time frame chart, let's first evaluate what's happening with the trend. We've certainly got lows, higher lows, and the opportunity for higher lows. We've got highs, higher highs, and of course higher highs on that Friday session. So the reason we say the opportunity for a higher low is because there's nothing about the chart currently on the hourly that would suggest buyers are stepping up around 512. And as we saw on the daily time frame chart, of course, Friday was a bearish engulfer. So if we do not hold on to this as a higher low, it's certainly looking like that continuation into the 509 produces an hourly equal low, and then the threat becomes a possible lower high, right? If we're thinking about trends, this as an equal low is not yet a threat to the uptrend, but if we can only produce some sort of lower high, now all of a sudden this starts to feel like a reversal pattern on the higher time frame, more zoomed out hourly or even daily as a possible head and shoulders. And if we were to break down underneath 509, as we discussed, you're probably neutral to slightly more bearish through here, with a firm bearish edge coming in on the equal low breakdowns underneath 505.25. So could you position for a lower high up against 512 if we fail to rebound off of 509 for a firm daily higher low, then really get continuation to back up here, let's say? Absolutely. So if you're a short looking at this market, what you really want to see is that continued breakdown for the equal hourly low, 509, and then a lower high on the reattempt of 512. A rejection there sets up the head and shoulders, and then maybe we have ourselves a stronger reversal to the downside, right? That's one opportunity for the bears. The other opportunity is just a straight shot lower, consolidation here. This is now a massive flush point underneath 505.25. We think the chart speaks for itself underneath that level. It's all about the NVIDIA earnings gap, right? So that's what the bears want to see, but we've already discussed how there's not really evidence of stronger sellers, and you can see that from a more nuanced perspective here on the hourly. If the bears were originally going to make something happen, this was the original idea for the head and shoulders. It simply did not take place. We did not get that lower high underneath 509. Here's the gap fill reversal on that Thursday session, and we're coming from the highest high in the cycle. So let's put our bullish cap on and say to ourselves, if we get this as a double bottom, inverted head and shoulders, simple hammer candle down here, all of those would fly for a reversal, and if we can recapture 512, really aiming for the equal high up around 518. That's very simple daily trend continuation off of an hourly trend reversal, or I should say hold, of the equal lows at 509. That, of course, is bullish. If we get the rainbows and butterflies situation, which is just consolidation up here, I think it's very straightforward. Obviously, healthier bullish consolidation happens over 515.25. You could look to buy these pullbacks for the flag consolidation, then look for the breakout here. If it's just a straight shot through and we do something that looks like this, the classic setup is looking for the higher low over 518. But understand, if we make a new all-time high, a new higher high at the upper edge of the weekly expected move, you could still afford a hourly pullback for a higher low here to here up and over 515.25. So there are a number of ways forward for the bulls on this particular chart. I would be more so inclined based on the daily evidence to support or align more so with the thesis of double bottom, inverted head and shoulders, or hammer here holding the 509, then looking for the more meaningful rotation back into this upper consolidation, getting over 512 and continuing the trend in the upward direction. If we check in with our anchored view apps intraday, what we'll notice is that there's pretty strong confluence at the 509 coming from before the NVIDIA earnings gap up and after the NVIDIA earnings gap up. If we can hold this level, makes sense that the buyers remain in control from both perspectives, right? Anybody who was a buyer before the NVIDIA earnings gap up or after the NVIDIA earnings gap up is still feeling pretty good about their position over 509. Now, is it possible that the momentum gets us there in the first place? Absolutely. If you look at the Anchored View app from Friday, we're underneath and rejecting into that Friday afternoon session, and the Anchored View app from the Tuesday low is also starting to break down ever so slightly at 512. The reason we're highly interested in 512 as the recapture point is for that exact reason. If we get the pullback to here, 509, and a lower high underneath 512, now anybody who really bought this pullback back here is not really feeling so hot about the potential position, and that puts downward pressure, sell side pressure into the market. So key levels on the hourly time frame chart based on everything we've discussed so far: 509, key line in the sand, 512, very important recapture if we get the full test of 509, right, for this. And then the bigger line in the sand for the sellers is way down here, 505.25. It's not unreasonable. It's not like it's impossible to get there, but as of right now, the alignment we're trying to produce is more so something that does this, constructive in the upward direction, something that does this, constructive in the upward direction. That's really what we would try to align with, but we're open to changing our tone on these possible outcomes as well. Lower high underneath 512, equal lows, chopping through here, looking for the breakdown. Straight shot to the downside, consolidation in here, flush point, breaking down, closing the NVIDIA earnings gap up. Nothing about the charts yet would support stronger sellers, but we're open to changing our mind if we get continued price acceptance below 509 or reject 512 on retests. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. If we just look at an overview of the internals this week, we certainly had decent volume inflows. They're not substantial, but they're definitely not out. And you might have expected that considering the breakdown, the gap down, the momentum to the downside on Friday. We had inflows, net inflows on the week. Advanced decliner is really more so neutral on the bearish early start and bullish into the end of this week. Cumulative tick really speaks for itself. We've got some downside builds on Monday and Tuesday, but Wednesday, larger read to the upside. Same thing here on Thursday and Friday. The bearish engulfer really does not produce a detrimental outcome for our market. I do want to take a moment though and zoom in on the Tuesday session. Tuesday is incredibly telling because if you look at what happened, it was the gap and go, right? We got that move in the downward direction. And even as the market was moving in the downward direction on Tuesday morning, look at your advanced decliner neutralizing to the zero line from a bearish open. Look at your volume reads getting positive here on the open. Look at your cumulative build going positive on the open, even as the market is moving in the downward direction. So again, it begs the question, if we had stronger sellers in the market at the exchange level for massive continuation, why, as the market was moving lower on Tuesday with the gap down, there's momentum to the downside, remember that, right? Why were the internals actually flipping positive on Tuesday morning's open? Doesn't make sense that we have stronger sellers, and we know what happened after Tuesday's low. The market rebounded back in the upward direction. So given what happened on Tuesday and given what we can see on Friday, no strong volume outflows, opened in trend higher zone, certainly closed neutral, and the trend was down on the day for the advanced decline line. Don't get me wrong, we're not trying to say that it's, oh my goodness, we're all bullish here. No, not the case, but it's not stronger sell side. And look at the cumulative tick as well. Hardly even gets negative into the close of day. So do we have stronger sellers? The answer continues to be absolutely not. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. The biggest takeaways here are that the value area on the Tuesday session is actually lower in the profile, as well as the fact that there's clear evidence short-term momentum buyers remain in control. The first point of evidence there is that we support directly off of the value area high on the Tuesday morning pullback. Remember, on Tuesday, we open here, there's a morning pullback, and then we rotate in the upward direction. Remember that if an institutional player, a large bank, hedge fund, whatever, gets an order across the desk to fill hundreds of thousands of ES contracts short, they're not going to stop at a previous value area high. Totally indicative of short-term momentum traders, people who can visually see the level and rotate off of it. The same thing happens here. The same concept really applies to the gap fill reversal on the Thursday morning low here in A period, right? We go right to the previous high and then reverse for a stronger close on that Thursday session. Stronger sellers do not care about a gap close. Now, we want to concede the point as well that Friday offers no acceptance at the all-time high. So just like we talked about on the daily structure, it's a bearish engulfer. We are not trying to hide the fact that Friday was certainly bearish, and there's absolutely zero acceptance at these new all-time highs. You can even see that the point of control, it was not like it was just flat sideways. It actually drifted in the downward direction substantially, not quite outside of the Thursday range, but pretty darn close. So the bears do have some momentum here coming into the early stages of the week. But the takeaway is that you probably don't want to be an aggressive short through here. You would really want all of this to turn into overhead supply. That's the Tuesday value area point we made first, right? You want all of that to turn into overhead supply, equal low breakdowns on the SPY daily, before we really start to consider the NVIDIA earnings gap close major threat here. Changing gears to the QQQs on a weekly time frame chart, what do we see here in terms of candle structure and location? Much different than the S&P. We've got ourselves a mostly solid red-bodied bar, a little bit of a lower wick, but I wouldn't read into it too much. We've still closed towards the lower third of the weekly range, a little bit of an upper wick as well, suggesting that same likely rejection rejection of the newer all-time high here. Very minor, though, in the QQQ, not nearly as pronounced as the S&P. So if we think about location on the bar-to-bar count, great segue. That is technically a higher high, but we've also got ourselves a lower low. So a bit more neutral location-wise, but more bearish in terms of structure. So about half point here for our bears. Things become much more interesting to me on the QQQ higher time frame to the downside if we were to actually break back down underneath these highs loosely around 437, right? And as a matter of fact, if we actually look at the lower wick in context of that level, it would suggest that although we did still close weak in the weekly range, we didn't close underneath that breakout point, and to me, might offer a little bit of support here. So what's the move going forward? It's very straightforward. Any consolidation up here on the weekly is exactly that. Weekly consolidation, bullish consolidation. The trend is certainly in the upward direction, right? We have lows, higher lows, higher lows, higher lows, higher lows, higher lows potentially being offered here, and along the way, of course, we have all-time highs, higher highs in the trend cycle. So that's bullish consolidation all day long. If we were to break down underneath 437, now I start to think about the situation we talked about in the S&Ps, where under 490 we can hit 480, right? About 10 points of rotation. In the QQQ, what that looks like is 425 here. I'm just going to drop a 25. Under 425, which is the bottom of this previous 3-week balance right there, then we can see the deeper pullback to the true weekly line in the sand, in my estimation, which is at loosely 410. Right, 410 over here, so about 15 points of pullback for that downside rotation. How does it look from a Fibonacci point of view, coming in from the October low to the most recent all-time high? This is starting to play catch up more likely, or more appropriately, I should say, with the top of the balance and the 38.2, right? The higher the new all-time high gets, the more likely that is to coincide before eventually it's going to be above the top of the balance range, right? So still really reinforcing the idea that pullbacks over 408 down to about, or up to about 410 as a 2-point zone still makes sense for a weekly higher low, and nothing will really change on the higher time frame charts. Again, can we get there logically? Absolutely. Some consolidation in here under 425. The door is open for that 15-point rotation, and just like the S&Ps, the anchored view app on the weekly supports that same idea, right? So this pullback low anchored view app breakdown underneath 425, it's right there. The door is open. If we are just supporting above it, there's really no reason to panic here on the higher time frame QQQ. I wouldn't be trading for larger downside outcomes. If we zoom this chart out, I just want to remind you that the previous all-time high is actually more aligned with a lower level than 410, 408. So still thinking about this as a zone down here. I really want to reinforce the idea on the QQQ weekly that that is a zone. 410 down to roughly what was this previous all-time high, 408.25. So just truly treat that as about a 2-point zone based on the structure we can clearly see in front of us right now. Let's check in with the volume profile because we have a little bit more of a takeaway here. This as a high volume node is the 425. Right, so if we break down underneath 425, then fine, 410 is a reasonable target on the weekly. And then, as we know, this is the larger line in the sand. It is the 38.2. So we're certainly thinking about weekly higher lows. Do the buyers step up at 410? The reason we're talking more, maybe concretely, about downside in the NASDAQ is because of the red bodied bar that we printed, whereas in the S&Ps, it's still a little bit more indecisive. A smaller edge goes to the bears here on the NASDAQ, and this is making sense confluence-wise with the volume profile. Just also remember that the next high volume shelf is basically down here at the previous all-time high, that 410 to 408 as a zone. So all good on that front. The last thing we'll check in on is, of course, the Fibonacci extension for the cup and handle. We know that we're probably nowhere close to the expected move because this was such a larger move in terms of magnitude than the S&Ps. Yeah, not even close towards that 475, but I do want to just reinforce the idea that the 61.8 is 425. If we break down, it makes sense that 410 could be achieved. So once again, you can kind of see where I'm coming from on the NASDAQ, more likely to flip bearish sooner on the NASDAQ than the S&Ps, but we're still not there yet. I don't want us to jump the gun. The last thing I suppose that I'll truly leave you with to make sure that we don't jump the gun is that we're still technically producing a weekly lower wick above the top of the previous 3-week range. On the daily time frame chart, we can start to see that the weekly expected move is really not that favorable for trend continuation. If we're contained by the upper bound, the number's at 449, implying an equal high to Friday's high. And if we're contained by the lower bound, the number's at 429.15, implying not only a lower low, but a move into the NVIDIA earnings gap. There's really thin structure through that zone. Maybe there's a little bit of support that could potentially be found at 430. I wouldn't have a lot of confidence in that level, but the gap closes all the way down here at 425.75, offering a higher probability outcome of a potential daily trend reversal here, which aligns with the weakness we just explored on the weekly time frame chart anyhow. So if you're looking for shorts based on all of the evidence we've seen so far, the NASDAQ continues to be the place where it makes more sense that the sellers have a bit of an upper edge. If we're thinking about the daily trend, it's uncomfortably still up, technically speaking, right? We have lows, higher lows based on the gap up. Tuesday certainly provided an equal low, but it was coming from a higher high, and on Friday we also printed a higher high. If we're looking for a higher low in the trend cycle, ideally we closed right on the level that needs to hold. This is a more refined version of the 3-week balance highs that we were just referring to on the weekly. I think we generalized and said 437. The true number is at 438.50. If we can hold up over this previous area of resistance and now use that as support, it offers a possible daily higher low from here to here. But let's be honest with ourselves, right? What's the issue with this potential outcome? Of course, on Friday, we've got the nasty bearish engulfer to deal with. We looked over Thursday's high. We rejected the all-time high. We moved underneath Thursday's low. We closed extremely weak right on the level. So it would make more sense to me that the momentum possibly continues in the downward direction, preventing a daily higher low, and instead getting bearish consolidation inside of this range right here. And what's the issue with that? Well, of course, this could be seen through the lens of a daily double top and breaking down through the neckline, aka the top of the NVIDIA earnings gap, at 433.75 opens the door for that rotation we just described. You could even go as far as calling this somewhat of a Man Ray pattern, right? Something that looks like this, and then we break down. There you have it, right? So could you be a short through these equal lows? Absolutely. That would make sense to me considering that we've already tested it a number of times. We're not coming in for a 100% retracement. The level is weak. Remember, the more times you test a level, the weaker it technically becomes. So underneath 433.75 is an idea on the daily, or a lower high underneath and in the gap is also an idea to close the gap at 425.75. Remember that the 50 SMA over time will slowly provide confluence of support, and I would watch out to see if we can get the weekly higher low at 425. Remember that really dangerous things on the weekly start under 425 to get to 410, but 425 for a gap fill reversal on the daily would prove to be bullish here if we could hold the 50 SMA. To get there, there's an opportunity for a daily downtrend, right? So this all stems from the lack of hold here at 438.50. We'll use some of these other levels to get granular on the hourly. If the buyers are going to retain control of the QQQ daily, what would it require? There's really only one situation in which I see that as a likely outcome, and it's not necessarily a true gap up on Monday outside of Friday's range. That would be a long shot. But if we could open away from the settlement from Friday, so Monday's open is maybe up here at 441.50, maybe there's an opportunity intraday for a move to the downside to test that level, and then maybe we're dealing with like an hourly double bottom off of 438.50. So let's move on down to the hourly now and really start to explore what's happening here from a trend point of view and how maybe there could be a hold of that level, right? So we know that there's downside momentum, but what's the hourly trend? We have lows, higher lows, and basically an opportunity for equal lows. We're already there on the QQQ. Along the way, we're coming from the highest high, so technically the trend is up, but there's certainly an opportunity for a lower high. So where would that lower high want to be found? Well, the bears would clearly like to see a lower high underneath this as previous overhead supply. 444.50 strikes me as the main place to be thinking about potential sell-side setups to keep the market more so neutral here on the QQQ. So if we're going to find ourselves in a balance range that's really starting to build out, so maybe technically speaking, we hold up outside of this as the original balance over here, and we're going to hold this as a possible daily higher low. You could get a balance that forms in here, but rejections up against that 444.50 really strike me as being ideal for the bears trying to continue to put downward pressure on this market, right? It wouldn't be a short, it wouldn't be, oh my goodness, the market's going to zero, but QQQ would be showing some signs of struggle if that 444.50 continues to reject prices for somewhat of a lower high from here to here on the hourly, right? So that's a concern. Now, why are we talking more bearish about the QQQ? We already saw the weekly structure. We saw the daily structure, the bearish engulfer. We saw the fact that we're closing right at the key level for the higher low. But let's also talk about exactly what we talked about in the S&Ps. A larger gap down on the Tuesday session. We did not close the gap all the way on Wednesday, so that's a sign that sellers are stronger, right? There's thin structure up here. The buyer should have had no issue closing that gap overhead. It simply did not take place, and we closed technically right at the level, 438.50. Technically speaking, high or low, sure, but really more of a threat to move back down into the original balance. Now, on Thursday, we still get the gap fill reversal. We move in the upward direction. That's fine. But earlier in the week, specifically Tuesday and Wednesday, the sellers were building a little bit more of an upper hand here on the NASDAQ side of the market. If we bring out the anchored view apps intraday and see what these would suggest, notice that we're technically under more of them, right? The anchored view app from the NVIDIA earnings pre-gap up and post-gap up, it's right at the level. I think that there's much more of an opportunity for the NASDAQ to display weakness, flip the trend here to clearly down, threaten the NVIDIA earnings gap, and that's downward pressure for the broad market as a whole. I think the S&P could maintain a little bit more of an uptrend, or it has an opportunity to maintain more of an uptrend there. The probabilities would favor the SPY remaining somewhat stronger, but tech, if it's going to be weak, if it's going to be underneath 438.50, you can just see how large of an issue that is here on the smaller time frame hourly chart. So I think the pathing is fairly straightforward. Again, if you're going to open up strong on Monday, you've got to open here, maybe test, and then you get some sort of a double bottom, reversal, whatever it might be. If we can hold up over 438.50, it's a bit of a last-ditch effort to the upside for our buyers. If we do get some price acceptance below, you're failing all of the anchored view apps. We are getting consolidation underneath the key zone. I think the NVIDIA earnings gap is the threat to the downside. If we take a look at the market internals for the NASDAQ side of the market, notice that opposite to the S&P, we had volume outflows happening here. We had an advanced decline line that was still over the zero line for the back half of the week, if you will, but much weaker on the Friday session. The cumulative builds on Monday and Tuesday were definitely stronger to the downside than what we saw on the S&Ps, and although not an end of the world style read on Friday, a little bit stronger to the downside on the NASDAQ compared to the S&P as well for the Friday bearish engulfer. If we think about what's happening from a market profile point of view, let's bring that one up over here. The same idea really holds true, where we really want to be patient for that larger flush to the downside underneath 17,850 in the NQ futures. If we break underneath that, we know that the NVIDIA earnings gap is in force. Remember that the Tuesday value is held lower in that overall session, so the position is held lower, and I really think you want to wait for that to turn into overhead supply. So 17,850 to the downside opens up that door. You can see on Friday, just like the S&Ps, we were getting rejections or just a lack of acceptance at that all-time high. We do technically have a poor high on the NASDAQ up there in B and C period, and okay excess during I at the lows, but again, still thinking about downside momentum, thinking about what's the opportunity for the sellers to get that equal low, and then what's the threat for a move into the NVIDIA earnings gap up. I think we've really built the case that the NASDAQ side of the market seems to be much weaker than, or likely to be more susceptible to sell side compared to the S&P as an index. And lastly, for the broad market, we have IWM Russell 2000 and the small caps on a weekly time frame chart. What do we see here in terms of structure and location? Almost similar to the S&P 500, not as bearish as the NASDAQ, right? So indecisive doji with equal size upper and lower wick. Indecisive close, very close to the opening print. We get it. It's neutral in terms of structure. But look at location. On the bottom of our account, we do have ourselves a higher low as well as a higher high, and we've closed a little bit further outside of the previous weekly range compared to the S&P. Certainly not arguing that this was a strong close on the weekly, but regardless, we want to try to remain more bullish and optimistic on the IWM, or at least I do personally. We've got ourselves the structure that would suggest, the location that would suggest, but most importantly, if we zoom out on this particular chart, we know that we're breaking out of a long-standing balance range on the weekly time frame, monthly time frame, like a year-long balance, right? If we can get this breakout, really the previous flat top becomes the target just north of 230. That really does align with a range double here as a measured move target. So liking it from that point of view, that of course would help dampen some of the downward pressure if the NASDAQ breaks down, right? If the IWM and small caps can play catch up towards those all-time highs, not directly to the all-time high, but even just that 230, 235-ish zone, it's going to help alleviate some of the downward pressure in the S&Ps if the NASDAQ takes a little bit stronger of a pullback in the downward direction, right? So in terms of the Fibonacci's, we are over the 38.2. It's been that way for a while. Ideally, we capture the 61.8, and then the odds would dramatically increase for a 100% retracement. Even again, if it's only towards that 235, 230 zone, that would be constructive for the broad market as a whole. If we flip the script and come in from the low up to the high of this move, we do have a 38.2 at the bottom of our weekly high or low, so all good there in terms of 190, 150, 192. But I would even argue if we zoom in on this weekly chart just a little bit, we probably want to see any weekly high or low pullback stay above this as a potential zone, and we'll sort of remember why on the daily chart in just a second. That level is 199 on the weekly. If you want to use the round number 200, whatever floats your boat, that works just fine. Let's take a look at the anchored view apps for small caps here. The cluster is entirely underneath us, for that reason, I would tend to align more so with, even if this were to pull back, there's an opportunity to catch support in here. The larger concerns on the IWM weekly time frame chart only emerge when and if we drift further back down into this range, but more importantly, if this were to turn into a higher high double top and we break down underneath this neckline, then I'm really concerned about small caps and the implication therefore for the S&P 500, the broad market, if you will, as an entire entity. Let's bring out the volume profile on the weekly and end on this note here. If we take a closer look, I just want to remind you that, again, trying to align with the bullish nature of the market makes sense, even from a volume point of view, right? We have this really thin volume, low volume void overhead. The high volume node is a little bit shy of that 230, closer to 225. It's the midpoint of this as a balance range, but regardless, the suggestion is that the market in theory should have an easier time rotating in the upward direction towards that high volume node, being drawn towards it, as opposed to rejecting arbitrarily in the low volume void and breaking down for a nasty failure all the way back down to the bottom end of the range. We'll change our tone when we have to, but as of right now on the higher time frames, bulls on parade. On the daily time frame chart, we can start to see that the weekly expected move is actually above our key line in the sand at 199. So not only did we discuss it as a weekly high or low, but we also know this level as the daily double bottom neckline right here. We'll also remember it as maybe an ascending triangle breakout point. The daily 50 SMA in blue here will be playing catch up very soon. All just different ways to describe 199 and the opportunity for a weekly high or low above to remain constructive in the grand scheme of, again, the broad market rally broadening out in terms of its nature via small caps participation. If we take a look at the immediate trend, it's certainly up with all of these consecutive higher lows. We had a little bit of an hourly downtrend in here, so maybe you could consider 204 the last higher low on the daily time frame chart, but I would be willing to give the buyers the benefit of the doubt coming from this equal high. Bearish bar on Friday, absolutely, but notice that we didn't close underneath Thursday's low. So this is not as much of a bearish engulfer. Yes, we made a new low, but we didn't close underneath that Thursday low. So to me, not as bad on the small caps here. And if we can find support, which that lower wick might suggest a little bit of, if we can find support over 206.15, that's just a beautiful higher low consolidation here, looking to align with higher lows over 208 on something like an hourly for continuation in the upward direction towards 211.50. And once again, that's supportive of the S&P being sort of caught in the middle between, maybe NASDAQ weakness but small cap strength. The S&P 500 is not going to break down as aggressively if the IWM is rotating back in the upward direction. I do want to point out, just for continuation as well, the next target overhead structurally over 211.50 is way overhead at 219.50. And if you recall, that's because the VIX was extremely elevated as small caps were breaking down. 2021, the late stages there, 2022, very, very high VIX. So those structural levels are much further apart, certainly further apart than what we're used to recently with a suppressed VIX, which is, certainly down towards the low. So keep in mind that over 211.50, there's not much structural resistance there. It doesn't mean that we can't reject somewhere arbitrarily in here, but pointing out as and if this weekly breakout really starts to accelerate in the upward direction, it's not much in terms of roadblockers overhead here on our way towards that maybe 225 target, 235 target, right? So daily chart mission accomplished. Let's drop on down to the hourly time frame chart. So I want to point out the sort of segmentation of the price action out of small caps recently. It's been doing a very poor job of actually trending intraday. So blocked off price action, end of day breakdown, right? Blocked off price action, end of day breakdown. Complete block of price action, same thing here on Thursday. Friday is really the only day that trends, and of course, it's in the downward direction. So we'll give the sellers a little bit of benefit for that particular reason. But as we pointed out on the daily, we actually didn't close underneath Thursday's low here. We are trying to find buyers in the lower wick of that Friday bar here at 206.15. If we get consolidation like this, I would look for that to turn into, maybe it's a double bottom. Who knows what the pattern exactly looks like, but let's just say it looks like that. Great. Higher lows over 208, aligning with that move back in the upward direction. If we slip it with a lower high, I would be more neutral through here. Don't get me wrong. If the IWM pulls back from this higher high, if it breaks down underneath 206.15, if it does something like this to maybe close the gap, test the lower edge of the weekly expected move, as the NASDAQ is also breaking down, of course, the S&P will also break down. But from the higher point of view, like we're talking weekly perspectives, we're talking like macro themes between small caps and the S&P 500, as long as we're over 199, it would tend to me at least, indicate more of a bullish tone for, again, the broadening nature of the market rally as we're moving in the upward direction. So 199 continues to be a key level based on all the takeaways we have so far. We know how we're trading in the downward direction on failures of 206.15. We know how we're trading in the upward direction on success over 208. Let's take a quick look through the lens of the intraday anchored view app, and what you'll notice is that's basically exactly what we have here at 206.15, breakdown underneath. Maybe you get something here for confluence at 204, and this is, technically speaking, the NVIDIA earnings gap is in between on your NASDAQ and your S&P. In the IWM, it just really represents the last higher low before more firmly recapturing that 199. So over 204 makes sense, and once again, is more bullish than bearish. If we can clear 208, there you go, over the anchored view app from the Friday high of the session. Let's take a look at the Russell internals, and what we'll notice is extremely neutral, really not much of an edge to the bears or bulls by the time the week closed out. We did have a little bit more substantial of a downside build flattening out, so neutral by the time the close comes around, and as we know, we advanced anyways, making higher highs on the week. If we look at the advanced decline line, all of them sort of trending lower, even though they're over the zero line into the end of the week, and on Friday, certainly building more aggressively in the downward direction. So do we believe that it needs to hold over 206? If we just go back over here to the IWM, do we need to hold over this particular level? It doesn't have to hold that way, but it would be ideal. Internals might suggest that, okay, we are coming in for a test of 204, and because of the anchored view apps, maybe we've got some confluence there enough to say, all right, if we find buyers, we're really looking for the S&P to either stop moving in the downward direction, or perhaps if the QQQ is also finding some sort of reprieve, some sort of buyers, maybe we look for longs in the S&P 500, right? So overall, I don't really see large deterioration out of small caps. We're certainly in uptrends across the board, trying to align with the weekly breakout. Let's finish it off with the Russell through the lens of the market profile, and everything's still like, I don't think we even need to change the analysis one bit, right? There is your value area low on the Tuesday session. Here it is on Wednesday, overlapping to slightly up. Poor low on the Thursday session has already been repaired. We've closed back above Thursday's low. So is it possible that continued holds over? Let's just bring out this level in terms of the futures, right? If we're over 2091, basically the base of the single print in A period, acceptance up here makes a lot of sense. Looking for that follow through in the upward direction. That's probably closely aligned with, if we just go back over here, yeah, I mean, that's going to be more so aligned with perhaps 207.25, but the idea, like the similar structure, would be the recapture and higher low over 208, looking for continuation in the upward direction. So very straightforward out of small caps. We're watching to see whether or not it prevents downward pressure in the S&P 500, or if it does pull back more aggressively towards 199, we can look for a stronger pullback in the S&Ps, but not willing to throw in the towel as long as we are over 199. So we can clearly see how the structural charts are really not all that damaged, but if we look at the S&P sectors and the posture that's there last week, this is where the cracks start to emerge. So leading the pack were utilities into the end of the week, up 3.78%, and we know that utilities are lightweight and deferred defensive. What did the market do on Friday? It made a new all-time high. Being led by utilities? I tend to think not. So that's not really the posture that, again, would suggest more of a full-blown risk-on rotation looking for follow-through out of this particular move. So the pullback thesis starts to make more sense when we look at posture. I mean, the TLT bonds even outperformed the S&P, up 2.17%, whereas the S&P was down on the week about 6 basis points there. Real estate follows it up 1.83%. Lightweight sector materials, lightest weight sector there is. Consumer staples, deferred defensive and lightweight. Energy, lightweight. Financials, you've really got to dig down this list before you find a sector that's like, okay, this is a heavier weight sector. It represents more risk on. I mean, up just shy of 1%, 99 basis points. That's a decent read, but on the week, as the market was making new all-time highs, being far surpassed masked by all these defensive and lightweight sectors, again, posture really strikes me as a concern here. At the bottom end of the barrel, we have the XLY, consumer discretionary, a heavier weight risk on sector down 2.06%. The XLK tech sector down 1.48%, and then followed up by communications down 31 basis points. Again, posture-wise, it's not really adding up when we think about a market that's making new all-time highs here. Let's check in on the structural charts and just see if there's any leadership issues in terms of, again, structure. Utilities, thankfully, are not breaking out to like new all-time highs. So it's not the worst. It could be worse, basically, is what I'm getting at out of utilities. There is an opportunity here for it to continue to act as a laggard. So outperformance last week, maybe it consolidates now over the neckline of this as a double bottom over 63. This as perhaps tech takes the baton back for a positive rotation. It's a little bit of a stretch considering the charts that we've already sort of looked through, but it's one possible idea. So overall leadership, not the end of the world here. We'll see that on the ratio chart as well. TLT, we'll dive into the ratio as well, but breaking this trend line to me would start to become slightly more concerning, especially if there's a quick rotation into 100. That would be like, okay, what's going on here? Why is there a flight to safety trade starting to unfold? Again, we'll take a look at the ratio, but bonds moving higher certainly would mean that rates are moving lower, so we'll see if that relationship ultimately plays out in the 10-year. We'll get to this stuff in just a moment. Here's real estate breaking out of this range more aggressively. Lightweight sector, upward pressures, upward pressure. It's not overly defensive, so I'm not concerned. Same thing here with materials breaking out to a new all-time high. It's lightweight, and again, we don't want to see lightweight sectors leading the S&P to a new all-time high, but upward pressure is upward pressure. It's not overly defensive out of materials. Consumer staples is a different story because it is lightweight and it is D for defensive. Do we see any issues with this chart? No. It's a slow grind in the upward direction. Structurally speaking, it's not producing a major new all-time high. It's not even close to all-time highs. So, again, when we zoom out and we take a really higher time frame approach, sure, could we get some posture issues here as we're printing a new all-time high? Could the market pull back? Could it reset for a daily high or low, weekly high or low? Absolutely. But way zoomed out, any issues like, oh my God, the market's going to zero, there are major concerns about recession, inflation, XYZ, not really when we look at the posture from that lens, right? So immediate term, like what happens on Monday, Tuesday, yeah, concerning. When we look at what happens over the span of 1, 2, 3 months, not really there yet. Energy, same commentary here, lightweight sector, upward pressure breaking out of the inverted head and shoulders, great from a global demand for oil supply perspective. Let's take a look at financials, right? Because these guys are playing nicely. Liking the breakout over the top of this range. Friday, unfortunately, not the most convincing looking bar, but still the opportunity for a hold over 40.45. If this can take place, if we can get this consolidation and continuation, that would strike me as healthy for the broad market rotation, especially as tech looks a little bit susceptible here. If financials can play pickup, that is a solid look. So 40.45, if we're above it, good to go. If we're underneath, not the end of the world, but certainly not helping the case for the S&Ps. We'll see that on the ratio grid in just a second. Here's the XLI industrials. Risk on, yes, but lighter weight sector, loosely 8%, new all-time highs. Nothing really bearish to say about this particular chart, trending in the upward direction. Opportunity for a higher low over 122. We'll see. The daily bar does not look convincing for more upside. We'll see if we get a deeper pullback, but consolidation here, not the end of the world. Really not the end of the world. SMH is where we got to put our big boy pants on and start to talk about the opportunity for some fairly substantial downside, right? Definitely a bearish engulfer. We'll talk about the NVIDIA implied volatility in just a second, but if we break down underneath 224, my apologies, under 224, we're really looking for a stronger retest of 212. And if that were to take place, of course, your S&P is going to feel the pain of that as the tech sector is really going to be the one that's more impacted, and that'll have the carryover to the index as a whole. So if we really clean up some of this thin structure, if we come in for a structural retest of 212, 12 points lower from where we're at, of course, you have to imagine the negative impact that has on the market. So with the bearish engulfer, I would tend to imagine that the momentum is there. It is an opportunity, but we'll see. I wouldn't jump the gun here. I would not aggressively be short. If you want to try to take a stab short, that's fine. Just make sure you know where your stop is, right? The worst thing that could happen is that everybody sees this one aggressive daily bar, everybody piles in short, doesn't move lower, everybody stops out all at once. What do you get? Perfect recipe for a short squeeze, right? So don't fall victim to that. Know exactly where you need to manage your risk. It does look like downside momentum wants to continue, but for me, and you guys know this, I'm more of a proponent for trying to watch where does the pullback take place? Where's the repeatable action? The repeatable action to me is not trying to step in front of moving freight trains. The repeatable action is finding, okay, where does the structural trend make sense to continue? And that at this point would be any higher lows over 212. So rant over on the SMH, moving along to healthcare, trading near all-time highs, trying to get this break out of the consolidation range. The Thursday and Friday sessions really don't look all that convincing, not much momentum in the upward direction. So consolidation is neutral. As we know, it is D for defensive, but it's the second heaviest weighted sector. If the market is going to pull back, it'd be great if healthcare did break in the upward direction as the pullback is happening in the S&P. That way, some of the damage can be dampened just a little bit. So, right, one possible situation is the SMH puts downward pressure on the XLK, but the XLV outperforms. Your S&P sort of like manages not as badly damaged, right? Next up, XLY. This is at the bottom of the barrel, right? What do we see here? A failed break up and over these previous highs with acceptance underneath. To me, the threat is just to move in the downward direction for a retest of this point in here at 176.50. Watching closely to see if we can find buyers, right? That would make sense for a weekly possible higher low to continue to emerge at the daily 50 SMA. If we really start to get one of these, though, what did we just draw in, right? There's your very classic head and shoulders. The larger damage really unfolds on the weekly underneath 176.50, and that would be concerning. So early this week, yes, be on the lookout for a possible failure of this breakout here. The acceptance is lower. Looks like we do have somewhat bearish momentum building intraday on that Friday. If we get the follow through, S&P is likely pull back. Next up, XLK, tech sector. Pretty sloppy looking chart, more similar to the QQQ as we likely know, but here is your double top, more concerned inside of the NVIDIA earnings gap. If we can find buyers up and over 206, not the end of the world. Really not the end of the world, not threatening these lows. That would be a higher low. A little bit more wiggle room here, a little bit more play room, if you will, for the XLK tech sector instead of the QQQ, which is basically closed right at the level. So if we do get this continuation, do we find buyers at 206? Do we stay above? Do we start getting higher lows, price acceptance over 208? Great. If so, the music continues to play. If not, highly, highly susceptible to the NVIDIA earnings gap breaking underneath 203.90. Next up, we've got the XLC for communications, and this is a look above and fail in the most classic sense there has ever been. Look above on the upper wick, failure with the close back down in the range, looking for some downward pressure into 78.30, and if we can find support off the bottom end of the range, we continue to maintain a neutral stance. If we break down underneath, here we go, testing that daily 50 SMA, possibility for a weekly higher low, but this is now major overhead supply. The risk is then a lower high underneath changes the daily and weekly trends, and then we look for stronger downside in the S&P 500. We're not there yet, but early stage look above and fail. Yes, the target should be for lower first. We would change our mind if we are getting firm price acceptance over 80, but as of right now, we've been in this range for so long, there's probably, likely lots of positions being built, lots of pressure, lots of anticipation. The fact that it failed so aggressively on Friday leaves me somewhat concerned in communications. Here is the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right hand corner. Some concerns out of the XLK, as we've already discussed on the structural chart, that NVIDIA earnings gap is a threat, but look at this as a possible sequence of lower highs. If we were to make a new lower low, certainly opens up the door for more pain in the S&P 500 and more of a risk off sentiment as a whole sort of like mentality and approach to the market. XLF is the saving grace, still over the somewhat flattened out 50 SMA, but you got to clear this balance range. If we can print a new higher high, and again, that's probably staying over 40.45, that looks good to maintain more of the risk on style look. XLV is D for defensive, so we want this to remain on a weaker style look over here, so all good on that front, no issues, still mostly risk on here. XLY is a larger issue, right? Noting that we've come in basically to an equal low here, rejecting a downward sloping 50 SMA. A lot of that pain has come from Tesla, of course. This is not good. This is not good for the market. So if I start to look at the concerns of what's happening here, the fact that this is just neutral, this is like okay, but we need to get that break. This is certainly not great. This is okay. We don't really have a full-blown risk-on style look, whereas this is uptrending, this is uptrending, this is uptrending, this is sort of more neutral, right? That's really the recipe, where these three, 1, 2, and 3 here, strong uptrends, more neutral, that's totally risk-on, right? So if we look at the risk-off sectors, the XLP, as we mentioned, right, it's in an uptrend, and in the immediate term, it's definitely more of a concern like Monday, Tuesday. But in the grand scheme of things, still in a downtrend here. XLU is still underneath the downward sloping 50 SMA. Real estate underneath the 50 SMA. Energy as a lightweight sector is just kind of more neutral in here. So I wouldn't call this a risk-off rotation just because the posture was poor into the end of last week. I would be skeptical of the all-time high, certainly. I'd be thinking about what's the opportunity for a pullback, but not really thinking about, oh my goodness, the market's concerned about a deep, dark, dirty recession. Really, the posture would dramatically shift if that were the case. Let's take a look at some specialized ratios here to continue to break it down. Here is the XLK SHY, still going sideways up here over an upward sloping 50 SMA. Definitely strikes me as still maintaining more of a risk-on style look. As we look at XLK XLU, this is where we start to stagnate a little bit and dial back some of that risk-on look, and now you can start to see, hey, there you go. There is the head and shoulders. We haven't made the lower low yet, but if it does happen, if we do get the lower low, okay, now we back off another step further, right? So we're not there yet, but it's not full-blown risk on based on the looks here. Let's move along to apples, XLY, XLP. Again, coming from the higher high was great, but why are we back down at an equal low? Why are we retesting this area on the particular chart? We tried to resolve it. We spent some time resolving it in here. Ideally, this would have pushed up to the equal high to maintain more of a risk-on style look. Again, I want to sort of balance that with the counterpoint. It's not risk off, and risk off really looks like breaking down to the bottom end of the range, but not great. Could have been better, basically, is the takeaway out of that one. And what about the SMH XLV with that nasty breakdown on the Friday session? You can still see that this is clearly in a risk-on style look when we look at semis compared to healthcare. Plenty of room for a daily higher low. So we're not willing to throw in the towel. Again, none of these charts suggest that risk off is dramatically the new flavor of the market, but we're just sort of skeptical about how much continuation we might get in the immediate term at this all-time high given the posture. Here's the dollar breaking down aggressively, in theory providing some tailwinds for our market in the upward direction. That sort of makes sense here, especially considering what's happened with gold. But as we know, it cuts both ways, and the magnitude of this breakout in gold as a defensive hard asset has to raise some questions, especially when the posture of the market looks like this into the end of last week. Like, why is gold aggressively breaking out to the degree it is? We know that the technical pattern is like, great, fine. We want to talk about this really massive, cup and handle from this point of view here. Cup and handle is breaking out. I get it. All-time highs in gold. Things really moving in the upward direction from a technical perspective. It makes sense. But from a intermarket relationship perspective, what does this massive breakout mean for equities? Why would there be a preference for the hard metal gold, which historically has not performed well, especially in relationship to equities down below? Like, why is there a flood into that? So it just raises another question mark about what's the sustainability of the S&P given the posture, given what's happening with gold at this all-time high. Are we finally due for a little bit more of a topping pattern? Again, the structural charts would not suggest so, but the market relationships are sort of getting torn apart a little bit at the seams here. Let's take a look at the TNX rolling over, as we already discussed in our TLT. If the TLT continues to break out, this moves basically in the inverse, and as theory should suggest, that would imply upward pressure for the market as a whole. So again, these intermarket relationships, they're not all adding up to a perfect, beautiful story as of right now. I would mainly pay attention to the TNX after the CPI print this week. So before we take a look at the tracker tool, what is the inverted ZT suggesting? I'd say it's basically unchanged from when we last checked in. Still looking at a substantial pause into at least the June timeframe, and then 50-50 odds around June. Let's take a look. So as expected, no changes here for March or May, and the June timeframe is still fluctuating between roughly 50 and 60% odds of a cut, which is really the interplay between a stronger than expected labor market and inflation sort of stagnating above the Fed's target after making a move off of the highs we saw over the last couple of years. So let's take a look at the labor data that came out on Friday of last week. Hourly earnings, small downtick over here, which is helpful to just suggest that we are not likely to experience continued inflation pressures from a wage price spiral. If we take a look at the labor force participation ticking in the upward direction for prime age workers, more so flat for the overall read here. But again, what's the suggestion? What's the takeaway? That's good for economic production as well as then consumer spending, right? If people don't have jobs in the prime age cohort, which is really when the majority of spending takes place, think about housing and think about vacations, just discretionary spending in those prime age years, that wants to move higher. So this is supportive of the idea that the consumer can continue to spend if they have employment, right? Let's move along and take a look at the actual non-farm payroll and where did the jobs really move. Certainly an uptick, which is healthy for the economy. The only loss of jobs was actually in manufacturing down here. That's the little -4. A lot of job gains in this purple segment right here, which is leisure and hospitality. So is that seasonal headed into the warmer months here? Spring, summer, we'll see if that sort of lasts. It's yet to be seen, but overall moving in the upward direction and at least not seeing a tick in the downward direction does strike me as a really positive takeaway here when it comes to the NFP that was released on Friday. If we look at the calendar for the upcoming week's worth of trade, so again, what does that suggest, by the way, the strength in the labor market? The Jerome Powell can keep rates higher for longer, right? Especially as inflation continues to come in hotter than the expectation. On a year-over-year basis, we're expecting a 3.1 unchanged from the previous read. That's, this is really not what Powell wants to see. He wants to be down here at 2%. Where's 2%? 2% would be in here. This is where we've got to go, and we're sort of stalling out over that read. So we'll see if we come in at the expectation. If we come in above the expectation, you better believe that Fed tracker tool is likely going to wipe away some of the probabilities that we get a cut as soon as June. If it stays at June, it would start to imply that the bond market likely knows something that we maybe aren't privy to. So really watching for that interaction on the Tuesday session in the morning there. Expecting a 3.1. We've talked about the month over months, 10-year and 30-year bonds Tuesday and Wednesday respectively at the 1 o'clock time frame, as they always are. PPI will be a little bit more of a nothing burger, especially after CPI, so not as concerned. Then retail sales might be interesting here in addition to consumer sentiment and inflation expectations on Friday at the 10 o'clock time frame. Things to be aware of, but the big sort of move this week is really going to come down to what happens with inflation. Do we move in the right direction? Are we moving in the wrong direction? That is a big watch on Tuesday, 8:30. We will have coffee and donuts up in the penthouse suites. Let's take a look at the earnings insights from FactSet here. And what I want to point out is that if you understand, well, basically, let's think about what June rate cuts mean, and then let's look at Q2 2024 and what we're expecting for earnings there, right? That's really where the market's saying, and the guidance from companies really is what's happening there. That's where people are saying, okay, we're going to get better in terms of profitability and just earnings as a whole will improve. That's really based on the premise that we do get a cut in the June timeframe. And what's the sort of thread here? Well, if on Tuesday CPI comes in hot and therefore we can stay higher for longer because the labor market is doing just fine, then what does that do ultimately to this column over here in Q2 of 2024? What does that do to calendar year 2024 earnings as a whole? And therefore, do we need to start pricing that in to the S&P 500? Just a string of thought that's worth continuing to navigate down. I also, before we want to jump on over to the current weekly earnings calendar, I want to show you the SOM rule. All right, the SOM rule is something that helps predict a recession when it's up and over a 50 on the signal line here, so 0.5 basically. That's when we start to get concerned with a recession. And this has to do with the rolling average of unemployment over a specific span of months. And generally, I just want to point out that we've backed away from this even as we saw an uptick out of the unemployment rate ever so slightly, right? A 3.9 from a 3.7. So not Armageddon style unemployment here. And we know that if we go back on over to, let's go back on over to this calendar, the unemployment claims, at least the initial on the weekly, are still very much so contained. We're not really breaching that 250,000 mark where things start to become like, okay, what's going on here? So as we bring, again, everything back to the forefront here and we think about all of these data points, I would tend to think that if inflation comes in hot on the Tuesday morning session, bad news is bad news for our market, and we do likely see some sort of more aggressive pullback in the S&P, the NASDAQ, and especially in small caps as a whole, being extra sensitive to fundamental and economic data. So watching out Tuesday at 8:30. Again, we do not try to predict. We just sort of react to these numbers, but as of right now, seems like an issue on the inflation side of things. Here's the earnings calendar for the coming week's worth of trade. Honorable mentions really revolve around Dollar General as well as Adobe. Adobe is not purely an AI company, but having some exposure to that, especially with the new Sora model from OpenAI. I'm wondering if they'll have any commentary on that. We shall see, but those are the two that really capture my attention. Let's take a look now at the market's appetite for risk. TLT ratioed to the S&P saw a small uptick, which really shouldn't be much of a surprise considering what we've already covered on the weekly performance there, but it's nothing major. This is not a new uptrend in the ratio. I would not call this a flight to safety. If we take a look at the bonds in relationship to themselves, they continue to rotate in the downward direction, and just as a reminder, this would sort of suggest an appetite for longer duration risk assets instead of shorter duration risk assets. Equities, of course, are on the long end of that curve. Let's take a look at the credit spreads, and what we'll notice is that they're just completely sideways, basically unchanged, no major risk of a credit event. If the market was pricing that in, we'd start to see some upticks, we'd start to see uptrends. It's currently not the case. Let's take a look at the HYG in isolation, so high yield junk bonds trying to break up and over this flat top, but really not getting anything going on. I'll continue to maintain the stance that really, as long as this is sideways, we're okay, and larger issues really start to emerge when and if we break down underneath 76.60. We're just not there yet, and obviously moving higher, trying to break out doesn't really strike me as a top of mind concern, but I'll probably set some alerts here for the coming week's worth of trade. Let's move along and take a look at Bitcoin continuing its break in the upward direction. That is a slightly risk on indication, and now we're moving into market breadth. Big move in the upward direction here. That is bullish. So although some of the intermarket relationships, sector posture is really not all that great, when we think about what we talked about on the IWM, this is totally supportive of the broad market rally broadening out in terms of its nature. Let's move along to the SPX A200R. Getting a tick in the upward direction is healthy from a breadth point of view. Same thing over here in the SPX A50R, moving in the upward direction, rotating away from the neckline of this as an inverted head and shoulders. Does strike me as a more bullish than bearish takeaway. What about the RSP equal weight S&P 500? No surprises over here. New all-time high. Certainly a bearish engulfer on the Friday session, but what would this suggest? This is not a one-stock market. This is not just NVIDIA. This is not just the tech sector. This is a broad-based move across the equal weight S&P. Let's move along and take a look at the QQQE. This is on a more zoomed-in time frame, and this is basically one-to-one. No issues on the NASDAQ side of things from a breadth point of view. Dow Jones continues to be a struggle here with transport stuck sideways in the midpoint of that range. Dow theory would classically tell us to be skeptical of industrials up above, but this is not enough information to just go out there willy-nilly and start shorting the S&P or even the NASDAQ. That just would not make sense. Here's the VIX, and this is interesting to me because we pointed out in last week's episode that this trend line could yield a bit of a move in the upward direction, and lo and behold, it certainly did. We're still underneath 15, and I would be concerned for a larger pullback if this can breach and get acceptance over 15. What is the precursor of the VIX? It's always the VVIX, volatility of volatility. And notice that we did tick in the upward direction. We closed a little bit more strongly here compared to the VIX itself. So I would be watching this very closely, the VVIX, into the early stages of this week. If we get a mild pullback, it's mild, again, keyword there one more time, mild pullback in the S&P, but the VVIX actually ticks higher, I would start to buckle up and start thinking about, okay, what's the opportunity for this to turn into perhaps something a bit more than what meets the eye? Let's take a look at the VIX futures. They continue to move into a backwardation here. Stronger contango, not a backwardation, which is really indicative of more risk in the future. Let's allocate capital in the present. So all good on that front. 9 versus 30-day VIX, same thing over here, same thing in the one-day VIX, just staying sideways. In the balance range down below, again, maybe a precursor idea would be watching for breaks or really price acceptance out of the one-day VIX up and over 1375, 14. If we start getting more prints up here, it's really more indicative and reminiscent of what happened into the October low. So we'll take that in stride when and if it happens, but we are not there yet. Volatility is not suggesting that it's an issue imminently, but I would keep an eye on that VVIX. If you've made it to this point in the analysis, I'm sure you're enjoying the show. Do me a favor, hit the thumbs up button, subscribe, all that good stuff. Most importantly, subscribe. Remember, the goal is 100K by May. Can we do it? First up on the chopping block for the core list of companies is none other than Apple. And what you'll notice here is a gap fill reversal on the Friday session for a bit of a counter trend move in the context of a massive breakdown through our flush point as described in last week's episode at 180.25. So multiple gap downs got us to where we are currently sitting. We closed one of the overhead gaps, sharply rejected it, and closed back down inside of what is now a 4-day balance range right here. So I would be highly attentive to, in Apple, the breakdown underneath 169 for a move into 167, and underneath that we have 162.75. If we zoom out on this chart, you can see things start to get really nasty below that into 155.50. I even want to grab a little bit more time here just to show you that that is sort of a weekly breakout point, right? You can see this is a flat top, inverted head and shoulders, pie in the sky, whatever. Big breakout, that would be the next major structure underneath 162.75. So being highly attentive in Apple to a possible stronger breakdown underneath 169, noting the failure in this gap overhead. Consolidation is good, breakdowns are good, lower highs are good underneath 169. I would only change my tone for a continued counter trend if we were getting acceptance over 173.75 to close the gap overhead. And even at that, a weekly lower high retest up against 180.25, something that does this, certainly thinking about lower highs on that retest. 180.25 once again as your key level. Next up is Microsoft. Let's dial it back a little bit on the amount of time we're looking at now. So a year will do. And taking a look at Softy, we're really just stuck sideways in this range. Now on a weekly time frame chart, this of course is bull flag consolidation. If we're actually going to trade this thing actively this week, we probably should take a look at the hourly chart here. Really don't want to diddle in the middle of this as a balance range. I would be more inclined for shorts on lower highs underneath 404.50, rejecting the bottom end end of this range, this low, this previous neckline of a double bottom, right? So if we're underneath 404.50, lower highs are interesting, targeting this equal low at 399. Breakdowns through that are a failure of the daily 50 SMA, looking for a stronger breakdown of the daily balance that we just outlined. So one step at a time, that all comes from a lower high kind of kicking things off under 404.50. If it's going to remain neutral, again, don't really diddle in the middle here, but a higher low over 409.50 kicks it back off in the upward direction. This is really a patience play, a wait and see play, as the daily trend is basically non-existent in this box at least, and we don't want to get caught on the wrong side. So patience, really have your risk defined on the intraday setups, especially when we're in the midpoint of a range. Next up, Google. What's going on the Google daily? Certainly suffering from all of the things we've seen in the headlines surrounding AI, surrounding the company values. So we'll see how that ultimately shakes out. But so far, just like Apple, large upper wick rejection on that Friday session, keeping us underneath this flush point in here. It was not a, I guess it actually was a little bit of a gap close, right? So gap fill reversal, closing weak underneath the level at 135.75. Thinking about shorts. We go on down to the hourly time frame chart here. I'd be thinking about shorts on consolidation here and breakdowns under 133.55 for a failure, right? Or just straight up break to the downside, lower highs, targeting the equal lows at 131. This is a poor low, right? If you could just think about from an auction perspective, all of those equal low buyers, there's likely someone underneath willing to undercut them. We'll look for 129 on a flush of that flat bottom, right? If we are going to flip bullish, if we are going to stay more bullish than bearish, you've got to prove it to me, buyers. You've got to show me something up and over 135.75, and then at that, probably only looking for the long trade on a break higher low over 138.75. Thin structure retracement might be interesting, but boy, oh boy, you've got a lot of work to do on the long side out of Google. Let's go back to a daily and move along to Amazon. What's going on with Nancy? It looks decent considering all of the downtrends we've seen in Google and Apple. Microsoft's kind of okay going sideways, but at least we've got more of an uptrend happening here in Amazon. Is this a balance range? Yeah, I mean, absolutely. We would certainly concede that point. I'd be more bearish on Amazon on breakdowns underneath 172.35 to close the gap and possibly rotate to the bottom end of the range. As of right now, trying to look for the possibility of a higher low. Friday's bar does not give me a warm and fuzzy feeling inside, so I'm not convinced on it yet. It would really require higher low price acceptance over 176. I think we could all agree that as a double bottom, as a neckline, as a level of importance, doesn't matter pattern-wise what you want to call it, price acceptance above that starts to feel better for a possible higher low, looking for the equal high breakout continuation, right? If we are going to move in the downward direction, we've already described it, and perhaps this is a Man Ray pattern, right? So legal will be on you if you try to pirate the name. Again, that's trademarked, Man Ray pattern. We own it, so be careful on that one. But anyways, under the neckline sort of kicks things off in the downward direction. Next up, NVIDIA. Oh boy, buckle up, all right? So let's go to a daily time frame chart. I do want to show you something actually in terms of our studies. Let's grab our option selling study set. So you be the judge here. Do you really want to step into NVIDIA, specifically on the call side, looking for upward payday when the implied volatility out of NVIDIA is now higher than it was ahead of the earnings announcement? Let me say that one more time here. The implied volatility on NVIDIA through the options chain is higher than what it was headed into the earnings announcement. Okay, what does that mean? It means that the magnitude of move that you need to get paid on your options is huge. So unless you're expecting NVIDIA to breach over 1,000 and trade into 1,100 in the span of one day, trading calls is extremely, extremely costly. Okay, so Matt, how does this all come full circle? What does it matter for NVIDIA? Like, why do we care about the implied volatility? I get it. I'm just going to stay away from NVIDIA. I'm not going to trade the options. All right, that's fine for you. But what does it mean for a stock that has mainly been driven higher because of a gamma squeeze? Well, if that dynamic goes away and there's a void, what has to happen? There, you guessed it, we're moving in the downward direction. So I'm not trying to scare you out of NVIDIA and say that, oh my goodness, it's going to go to zero. I'm also not suggesting that you should get puts because you believe that this is going to take place. But what I am suggesting is that the dynamic has changed now that implied volatility is so costly on the actual options chain, right? So for that reason, I am, not as interested in trading NVIDIA, that's for sure here, even though earnings are a non-factor. Just want to sort of lay that out on the line. Let's give this a little reset, go back to NVIDIA, and we'll take a look with a cleaner chart here. So on the daily time frame, I think this thing really speaks for itself. With the nasty bearish engulfer, lower, the big retest level is way down here at 802.85. Let's take a look at the hourly, just because I think we can probably put that on the screen a little bit more appropriately. So bearish engulfer, there is your retest down here at 802.85. There's a lot of room to to go until that's ultimately achieved. So again, is the idea to short this thing because you believe the gamma squeeze is going to come to an end and it's going to grind in the downward direction? Probably wouldn't take that route, but what's the idea? Maybe lower highs underneath this, trade for that level over time, or at least the gap close. Any lower highs here can position for shorts on some sort of like head and shoulders type idea, something that might look like that, right? So those are ideas, but NVIDIA is really just a no-touch stock, considering what's happened with the implied volatility, just not wanting to get caught on the wrong side of that potential trade. So you could take a mental snapshot if you'd like of the levels and sort of get the roadmap, if you will, here, but just know that in my heart of hearts, I can't really give you a path if it's not something that I'm going to be trading here. Next up is the metaverse. What's going on with Zuckerberg's Fantasyland? What do we have in terms of metaverse? So double top, yes. Underneath the neckline, yes. Any lower highs underneath 510.75, yes. We are looking for some downside. Again, legal will be on you if you try to hijack it, but there you go. There is the potential for a Man Ray pattern. The stronger neckline, therefore, might be underneath 499.75. Trades in the downward direction for a stronger retest of the level down here at 490. Is that the end of the world? Let's go back to the daily time frame, and I think what we can clearly see together is the answer is no. If we get something that looks like this, still looking for a daily higher low and trend continuation back towards all-time highs and blue sky territory. So not really concerned out of Meta. I think Zuckerberg has done a great job here, and he's really turning the ship around. So anyways, higher lows over 490 as a line in the sand. How do we get there? Breakdowns underneath. Let's just call it 500 for round number's sake. If we are going to consolidate up here, I think it really just makes our job easy. Breakouts, blue skies, higher lows, blue skies, pullbacks over upward sloping VWAPs, blue skies, right? Next up is Tesla. This is what's putting the downward pressure over on the XLY as a sector, falling off of a cliff, now making new lower lows underneath the head of the inverted head and shoulders, which kind of kicked off the beginning stages of what was looking like a daily trend reversal. Well, not so fast. We are getting these, again, what is this? You want to trade that? Do you really want to trade that? So Tesla to me is very clear here, very clear here. If we are going to move in the downward direction, let's go to the daily chart so I can show you the levels. Previous, ironically perhaps, inverted head and shoulders neckline is the first target at 165.75. The head of that pattern, the shoulders of that pattern, 159 as the next one below. So, I mean, overall, the trend is certainly down. You had an opportunity for a trend reversal in here. It was very short-lived, bearish engulfer, and it's not a place to be thinking about longs. I would say until there's easily a firm higher low over 182, maybe we rotate back into the original neckline at 193. But very, very cautious of long trades out of Tesla at this point, thinking about how to align with downside underneath this is a balance range, lower highs under 173.15, 165.75, and then again 159, as that ultimate target. Last but not least, before a couple of trade ideas for you, is going to be Netflix, as always, bringing up the rear. What do we see? Inverted hammer on the Friday session, kind of a failed breakout up and over those 3-day highs. Still trading, though, in an uptrend. Lows, higher lows, higher lows, higher lows. Certainly an opportunity for that to continue here if we get consolidation over 605, breaks higher lows over 616. Remember, large upside target 644.75. Don't need to be the first one in the door there. You can wait patiently for the evidence of acceptance over 616 first. If it is a move in the downward direction, I would really start to participate underneath this as a head and shoulders neckline. There it is. Not so much a Man Ray, but you get the idea. That's underneath 590.25. And then you are on your way for the evening. Marvel is up first on the chopping block in the semi space, and of course breaking down like NVIDIA on that Friday session. But notice how close we are to the retest level for the breakout point. The number is at 73.50, or we could go for the full gap close down to 71.80, the high of that prior bar. So if we can find buyers loosely in this area here, is it worth taking a stab with tight risk for some sort of reversal back in the upward direction and the trend remains up, right? If you can put your stop here, enter somewhere in here, and then retarget these highs, maybe from a swing point of view or just generally start thinking again about longs in this area, to me that makes some decent sense here. The time in which this would be just completely off of our radar is if the sellers come in, produce another large red bearish bar, closing inside of this consolidation. Not interested. I think for a lack of a better term, the balloon is popping or maybe just deflating a little bit. I certainly don't want anybody to think that, this is like complete bubble collapse. Oh my God, everything's going to zero. Nah, we're just deflating a little bit here in Marvel. If we look at something like AMD, obviously we're choosing things outside of NVIDIA for the implied volatility reasoning that we just had. We're just much further away from that retest level, whereas Marvel is certainly within striking distance. So if you wanted to watch AMD, not the end of the world, but your level is a little bit further away, and just to give you the number, might be closer to 182. Next up, we're going to take a look at BA for Boeing. What's going on with Boeing here? And Boeing is certainly breaking down potentially underneath this big flush point. right? It's the first daily close we have underneath 200. Can we get some follow through into this previous reversal point at 187.50? It's a possibility. I wouldn't be like, going after this setup with everything I've got. It's really a back burner idea that we have on our radar. We know that there's been a lot of just, news-wise issues with Boeing, investors taking issue with Boeing. So underneath 200 with price acceptance, looking for that continuation into 187.50. But once again, this is not like a primary, oh my God, this is the top watch into the coming weeks worth of trade. The last trade idea for you is going to be on WMT Walmart. Again, a couple of folks have mentioned and reached out after the split saying it trades okay, but it is a little bit slow, and rightfully so. I mean, the deltas have been cut in 3. But neckline, right? We've certainly got a retest of the neckline. So there was the double bottom pie in the sky setup we talked about, cup and handle, coming in for a retest of that level at 59.75. If we can find buyers, continue to find buyers, Friday already did. Notice the relative strength out of a consumer staple like Walmart versus something in the tech sector, right? This is looking pretty good compared to what we saw in those NVIDIAs of the world, the Apples of the world, the Google rejections of the world. So if this can hold up over 59.75, looking for that rotation back up to the equal high 61, then possibly moving into, I believe, blue sky territories here out of Walmart. So that's what I've got for you on today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. Remember, 100K by May. If you're not subscribed already, do me a favor, hit the red button down below. And with that said, we will see you live for the pre-market prep on Monday up in the penthouse at 8:15 Eastern time. We're back home, no longer going to be pressed for that West Coast local time. Man, that was brutal. But with that said, everybody, I wish you a green trading week.